Corporation tax, chapter 13. Okay, so we spent all our time so far on individuals, pretty much. So now we're going to turn to the role of the company. Starting with the big picture. Corporation tax is a key area of the syllabus. It will always be examined. It has to be. It's a company. It's some key knowledge you need to get to grips with. Corporation tax. A period of account is the period that the company prepares its accounts for. So the year end 31st December 11 is a period of account. A company can generally prepare accounts for any date it chooses, and whilst it's normally 12 months, it can be shorter or longer. That's the way to remember it. So a period of account can be shorter or longer. An accounting period is the period for which the charge to corporation tax is made. An accounting period can never exceed 12 months. Okay? Has to be 12 months or lower. Never be more. Most of the time, the period of accounts and the accounting period are the same dates. If a company has a period of account longer than 12 months, the period of account is divided with the maximum length of an accounting period, as I say, being 12. So if you have 18 months, oh here we go, an example of 18 months, then your accounting period of 12 months followed by an accounting period of 6 months. And that's how you'll do your tax, your corporation tax computations. Corporation tax computations, so here's an example, year ended 31st of March 2012. So somebody's calculated here that the trading profits are 150. They've got property rental income of 30,000. They've got some interest income, chargeable gains, total profits. Now, if the company makes some gift aid payments, they come off here, 35,000 in this example. Profits chargeable to corporation tax, PCT, 200,000. Now, differences. There are a number of similarities between how items are treated for corporation tax and how they are treated for income tax. There are, however, differences. There are no private use adjustments. You remember we had an example of a car, and the car could be used by the proprietor. Doesn't matter if the finance director uses a car for private and work use. There is no private adjustment to that capital allowance computation for that car. Okay. With companies, the companies themselves clearly don't use it privately. Capital allowances, there is no private use for a company. Right, property income, main difference for companies. Property income is still assessed on the accruals basis, but a company is assessed according to the company's accounting period, whilst an individual is assessed according to the tax year. So a tax year 11-12. You wouldn't say to this company up here, oh, your corporation tax is year ended 31st of March 12, therefore that's in the tax year ended 5th of April 2012, that's 11-12. You don't do all that. You apply a tax rate to the accounting period based on financial years, which start 1st of April. Interest on a loan acquired to purchase or improve an investment property is treated under loan relationships, whereas individuals, so it's not allowable, it basically has to go somewhere else. In fact, it basically comes under here, can go under investment income, interest income, not property income. Interest on a loan acquired to purchase or improve an investment property is treated under loan relation rules. Yep. Individuals can treat this as a deduction from property, so they do get it as allowable expense. Interest income, main differences, well, a company will always receive theirs gross, no tax withheld. Dividends received by companies are not included within profits chargeable corporation tax. They are not taxed because they come from another company, and it's basically company to company within the UK, therefore it's the person who pays it isn't allowed it as an expense, therefore it makes sense to not tax the receipt. Individuals, however, include dividends received within their income tax computation. Chargeable gains, main differences. Companies include capital gains as charged within profits charged corporation tax, and they pay corporation tax on it. Individuals pay capital gains on tax on gains and not income tax. They also have a personal allowance as well. Don't forget capital gains tax, about 10,800 or so. Gift aid. Companies make gift aid payments gross, and the amount paid is deducted within profits chargeable to corporation tax. With your individuals, what you do is you extend the basic rate. So to calculate the corporation tax liability, we need to identify the profits of a company. Profits equals PCTT plus franked investment income. So although the dividends aren't particularly of any interest when they're received because they're not taxable, you do need them for this calculation. FII, what is FI? It's gross dividends received from non-associated companies, so not related. What you do is you take the dividend multiplied by 100 over 90. Now, why is this important? Well, the reason it's important is because profits are used to identify the tax rate that you will use. You know, in personal allowances, personal world, we have the tax bands, and we have 20%, 40 and 50. In companies, it's the financial year which runs from 1st of April to the following 31st of March, and tax rates are set accordingly. And the tax rate for the financial year 11, which started April 11, are 20%, 26% above 1.5 million. However, if your profits are between the lower and the upper, you get taxed using this marginal rate calculation. What is the marginal relief? Well, let's have a look. Supposing you have profit chargeable to 200,000 and your FII of 15. Profits are therefore 215. This puts you below the 300,000 limit, and therefore the lower rate of corporation tax will apply. So 20% times 200,000 equals 40,000. If you have profits above the upper limit, you calculate that by adding those two numbers together. It's above the 1.5 million limit, so you pay at 26% equals 520 tax liability. Now, if you're in the marginal rates, what you must do is tax it at the full rate, which is 26%, less a marginal relief, which is this formula. Okay, and this is why profits are important, because it's the PCTCT plus FIII. Okay, so that's why it's important to know what your FII is. Now, let's work that one through. Your profits here are 1,050,000. This is above the 300,000 lower limit, but it's below the 1.5 million upper limit. So you do the full rate times the million, gives you 260,000, not times 1,050,000 by the way, because that's profits, less 3 divided by 200 times the fractions 1,500 minus 1,050,000 times by 1 million divided by 1,500. And that would then be your tax liability. Now, if the accounting period is less than 12 months, what you simply do is the upper and lower limits are reduced proportionally. So kind of makes sense really. If you have a company which only has a 3-month accounting period, then clearly 1.5 million even times 3/12 gives you 375. 300,000 times 3/12 is 75. So those are now your upper and lower limits. Now, obviously, a simple way to get round these limits is to have many associated companies. So, of course, legislation was introduced to stop this tax avoidance scheme. And basically if company A owes company B, you have 2 in the group, and therefore your upper limit and your lower limit are divided by this number. So each company have to work their profits out in accordance with these revised numbers. Otherwise it was very simple to set up many companies with their profits and losses in, and obviously they'd all fall below the lower limit. Now, if your accounting period straddles 31st of March, you're going to have to watch for these different rates, because your financial year, okay, pretty much 21%, 21%, 20%. So you want to be able to put some of your profits that are going to be taxed into this year, because it's a lower rate. Look at this on the main rate, how it's dropped recently. So you clearly, if you could put some income into here, you would. And if you could do some expenses and time them, you'd take them from here and put them here. So you can get benefit of a higher tax relief. So income, if you knew the rates, which when they're announced you'd go that way, but expenses, if you can, you'd bring forward and put them in the 2010 financial year. When the accounting period covers 2 separate financial years and the rates of fractions are different, then separate calculations have to be made for each financial year. What do we mean by the fractions? We're talking about this thing here. Now, not a problem, not a problem, not a problem. Ooh. Yeah. So if your financial year crosses 2010 to 2011, you're going to have to calculate a little bit more. Now, best way to do is explain this by doing an example. 2 million profits chargeable. It did not receive any FII, so profits chargeable is the same as profits. The year ended 31st December 2011 is partly in financial 10, which is January 11 to 31st of March 11, and partly in financial year 11, which is from the 1st of April 11 to 31st December 2011. The upper limit is 1.5 million in both years, so it will be paying therefore tax at the top rate, 28%, 26%. 2 million times the relevant number of periods, and that's your tax liability, 530,000. Now, trading losses for a company, a bit different to an individual. The company can utilise the loss in the following ways. It can carry forward the loss to offset against future trading income of the same trade. So that is actually quite similar to sole traders. It has to be the same trade. It can offset current year trading loss against current year total profits before deductions of gift aid. So again, quite similar to sole traders who set it off against total income. If a current year loss offset has been made and there are losses remaining, unused losses can be carried back and offset against total profits of the previous 12 months. You can go back 12 months. Now that's quite important when we have the different tax rates. So if you're making losses now, you want to carry that loss back, basically, because you're going to get relief at a higher tax rate. Okay, so that's companies. First time we've had a look at them. A difference that wasn't mentioned, I don't think, in the slides, but I would always mention, is you don't get personal allowances for companies. Both the income tax 17475 and the capital gains tax, they don't apply. Okay, end of chapter. See you in the next one.